Good morning and welcome to the Shenkman Wealth Management Accountant Attorney Summer Webinar Series. This program is entitled Timely Estate Planning Strategies for Private Equity and Hedge Fund Executives. For those who don't know me, my name is Jonathan Shenkman. I'm the president of Shenkman Wealth Management. In that role, I work as a financial advisor, portfolio manager, and fiduciary for my clients to help them achieve their financial goals. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. One quick note before I introduce our esteemed speaker, which is the handout to this program was sent out within the reminder email yesterday morning and this morning as well. It will also be sent out again in the follow-up email to this program tomorrow morning. Today, we're privileged to hear from Kevin Matz, partner at ArentFox Schiff, based in New York. Kevin counsels clients on a range of estate planning strategies, including wealth transfer planning, generation skipping transfer tax planning, charitable gift planning, probate proceeding, and associated litigation. Kevin has advised clients on entity and succession planning, including use of family limited partnerships, use of grant or retained annuity trust, transfers to irrevocable trusts involving complex valuations, qualified personal resident trust, irrevocable life insurance trust, and the use of charitable remainder trust, charitable lead trust, and private foundations to further family planning and philanthropic objectives. Kevin is a fellow of the American College of Trust and Estate Council, for which he currently chairs its Business Planning Committee. A frequent speaker and author, Kevin presents at national industry conferences on the use of leverage transfer techniques and estate planning for groups ranging from private equity fund managers for professional athletes and creative artists. Kevin is also recognized as a national leader in the area of qualified opportunity zone funds, and in the July 2019 testified before the U.S. Department of Treasury concerning the proposed regulation on qualified opportunity funds. Today, Kevin will be speaking on timely estate planning strategies for private equity and hedge fund executives. And with that introduction, I now turn the program over to Kevin.
Well, thank you, Jonathan. And hello, everyone. Good morning. So we're going to talk about a very high-level discussion. We're not going to go as much into the weeds, except to the extent that the tax rules require us to, and well, sometimes they do require us to. We're going to talk about estate planning strategies for private investment fund managers, executives at private equity shops, hedge funds, and like. And I know that there are some differences. We're going to talk about generalizations and then dig in. We're going to alert as to the various tax rules, which could act as tax traps, talk about the opportunities, talk about some of the rule of thumb planning approaches that you hear about with carried interest, get a sense of what's involved with the various funds and the interest that the fund manager could have or may not have, and how that affects the strategy. And what are the things to watch out for? What are the techniques? When might want to use a grant or retained annuity trust or grant, or instead make an outright gift, sale to intentionally defended grant or trust, perhaps have defined value formula clauses built in. Talk about all that, again, really at the high level over the course of the next hour. And I say high level because this program could otherwise be, if we dig into the weeds of the various tax rules, could easily be 3 or 4 hours. We're not going to do that. We're going to, a lot of that is in the PowerPoint. You can look at it, peruse it at your leisure. But again, very high level discussion. So with that, let's talk about our transfer tax landscape here in 2022. What is a current set of circumstances? And again, I'm going to proceed. This is a national webinar. I'm going to focus a little bit on New York, where I'm based, but really focus at a high level. What is the environment? Well, right now we're looking at an all-time high as far as exemptions for estate, gift, and generation skipping transfer tax purposes. And it's $12,060,000 per person. What that means is for a married couple, you can double that. You're at $24,120,000. that can pass free of federal estate tax between two spouses. Now, this exemption level, importantly, is not scheduled to last forever. It's only, it got, basically there was a $5 million exemption that going back to 2013, and 2011, 2013, that doubled with the Tax Cuts and Jobs Act that was enacted in December 2017, but doubled with an outside date, a reversion date, that as of January 1, 2026, after December 31, 2025, that doubled exemption, which again is $10 million as indexed up to $12,060,000 right now, it then reverts back to $5 million with indexing come January 1, 2026. Now, there are regulations, final regulations that came out in 2019 that talks about the situation of, let's say you make gifts with the doubled exemptions, and then you die in an environment after December 31, 2025, when the exemption is reduced down to $5 million. Is there some sort of clawback that applies for the gifts that you make now with the doubled exemptions when you die? General rule is there's no clawback. You can make the gifts. It's sort of a use it or lose it, because if you don't make the gifts and use up your exemption and you die in an environment of a lower exemption, you've lost the opportunity to give away, to make tax-free gifts, essentially. The only wrinkle on that is that if you have a situation, and there are proposed regulations that came out in April of this year, April 26th or thereabouts, there are proposed regulations that say that if you have a completed gift, but the amount that you gifted, because of various string provisions of the Internal Revenue Code, gets brought back into one's gross estate for tax purposes, and death occurs after December 31, 2025, in that case, you may have a clawback, so-called, it's been discussed as a boomerang time clawback, and only get the benefit of lower the exemption amount at the time of the gift or the time of death, if that's after December 31, 2025. That's the exception, though. If you have a completed gift and you don't have the string provisions, which we'll talk about, the Internal Revenue Code applying, in that case, you got to utilize the full expanded exemption that currently exists. What happens when you get above the exemption? Well, you then have a tax rate, federal tax rate at 40%. So that's important to bear in mind. It's 40% above that. Now, some key considerations. Interest rates are going what? They're going up, right? Section 7520 rate, which is the rate that we use to determine what the annuity gets calculated on for grant rotated annuity trusts, GRATs, is now for July 2022. And I know today's June 28th, but it'll be July in a matter of days, this coming Friday, will be 3.6%. The applicable federal rate for loans that are between three years and 9 years, up to 9 years, for July 2022 is currently much higher rate than it's been previously for the past several years. It's going to be 2.99% as of July 1. Now, when we talk about transfer taxes, estate taxes, you also have to think in terms of estate taxes. Not all states have estate tax. The state of Florida does not have a state estate tax. State of New Jersey does not have a state estate tax, although there is an inheritance tax that applies for property that's inherited by someone other than close family members. New York, the great state of New York, which I hail from, has an exemption that is much lower than the federal exemption. Remember, federal, we're talking about $12,060,000 per person here in 2022. If you look at a spousal unit, you double that to north of $24 million, because there's this portability concept for federal purposes, which means that if one spouse dies, there's unused exemption. You file an estate tax return, it carries over to the surviving spouse, and that's how you get the benefit of $24 million, not just $12 million, $12,060,000. New York doesn't have that portability concept. New York has a lower exemption, which is for people who die in 2022, New Yorkers who die, currently sitting at $6,110,000. Okay, but New York, unlike the federal system, has this very nasty feature to it. It has what's known as an estate tax cliff. What do I mean by that? It means that once you get above that exemption amount for New York purposes, just a little bit, within 5%, all the credit that corresponds to that exemption amount gets snatched away on a hyper-accelerated basis. So that once you get 5% above that 6,110,000 figure, you're taxed from $1, which is not good, not good. And that's something that a number of folks, myself included, have brought to the attention of the legislature as not exactly being fair, because it actually produces a confiscatory estate tax above 100% tax rate when you're within the phase out of the exemption range. But thus far, the legislature has not acted on that. Something to bear in mind. The last note here on this page, there is a potential for change to the legislative landscape for federal purposes. If we were having this talk last year, in particular during the fall of last year, we'd be talking about all these potential changes, perhaps a quicker reversion to the of the exemption amount to 5 million plus indexing instead of 10 billion plus indexing. Perhaps rules that would limit the ability to plan with grantor trust, and having grantor trust treated as outside of the so-called, beyond the so-called tax fence, and be able to have beneficial transactions with it that are effectively disregarded for income tax purposes. All that was placed in jeopardy. Planning with grantor retained annuity trust as well. There were talk about limiting that and maybe having a 25% minimum gift amount, lesser of 25% or $500,000. Limitations on step up in basis, deemed capital gains on death. All these proposals were presented last year, and this would be a very, very different discussion. But none of that has been enacted, and of course now we're in a midterm election year. So it's, I think, very unlikely that anything gets enacted this year. Now, depending on what happens in November, I guess we have to look and see what happens in 2023. But as of now, it sort of is silent on that front. But there is always a potential for further legislative changes down the road, which again could affect exemption amounts. It could affect some of our favorite planning vehicles, such as planning with grantor trust. It could potentially affect the ability to get a step up in basis on death, and having no tax consequences whatsoever on death. Again, not the current situation, but depending on what happens in November in the election, there's always a possibility that that gets revisited come next year. So just something to keep an eye on. Now, when we're talking about private investment funds, and there are some differences between private equity fund structures and hedge fund structures. Hedge fund structures quite often have high watermarks and like, which is not part of the private equity fund structure usually, unless there's a side pocket that's associated with it. Couple different things to bear in mind. See where it indicates private equity fund in blue. There are a whole bunch of interests that are held by different players in the ecosystem here. So you have the investors, the investors, qualified purchasers, accredited investors, and the like, who are limited partners. They get a return that effectively we're going to call here, and we'll see why shortly, a preferred return. You also have a management company involved that gets paid management fees. Something to bear in mind about management fees. Management fees, when they get paid, it's taxes ordinary income, which means tax rates that apply for ordinary. We don't get the capital gains preferences of having a 20% rate that apply, plus perhaps a 3.8% of net investment income. You're subject to higher rates, to 37% and like management fees. You see where it says the rectangle fund general partner. Couple different interests go there. So you have the interest by virtue of being a co-investor in the fund. And then you have what's circled here, these carried interest distributions. Very, very important. What that pertains to is the way that funds are quite often structured, that once you achieve a certain hurdle level of return, there is an allocation. It could perhaps be 20% above, say, a 9% or 8% return. 20% of that goes to the fund's general partner. And that goes to the fund's general partner, despite the fact that there's no additional subscription investment. It effectively is it's a profits interest. It's a reward for exceptional results. And that's very, very significant because that then when that comes in, when those amounts are received, it's not earned income. It's of the nature of capital gain. And also, that becomes a wonderful vehicle or contract right for purposes of estate planning. And why do I say that? It's because that's where a tremendous amount of growth is. The ability to have an interest that right now an appraiser may say is, well, you've got to achieve an 8% return on the investments. We see what's happening with the economy, stock market. We may be going into a recession. Interest rates going up. We don't know if you're going to be able to achieve that. And only after you have an 8% return or whatever, 9% return, whatever the fund calls for, only then do you get paid the interest and the carry. Appraisers, quite reasonably, will say, well, there's so much speculative element that goes there, so much optionality that it's not going to be worth very much. It's like an option, speculative investment. Sure, it could be worth a lot, but if you look at all the concepts as to everything that has to be paid first, and there could also be so-called clawbacks, amounts that get paid out on account of the carried interest, if it's before the entire portfolio company, all the portfolio companies have been sold, there could be a clawback or escrows involved. They might have to be repaid, except for the extent that exceeds tax distributions and the like. It's not going to be worth a lot for gift tax purposes. However, what could happen? It could be a home run fund. And if it's a home run fund, it gets 20% residual gains, investment gains above that threshold, say 8% or 9%, which means something that may be worth very, very little right now has a potentiality to explode in value, explode many multiples, tens, if not hundreds times above what its value is in the early stages of a fund. Now, again, you have to consider where you are in the fund's life cycle. Is it a mature fund, in which case perhaps you don't have the same optionality for explosion in value, or is it early, in which case the return is speculative, so many things can happen, you're subject to the economy, you have another COVID outbreak, everything that's happening in Ukraine and the like, everything with gas prices, recession, all these clouds in valuation that our appraiser friends will say, well, it's not worth a tremendous amount, but it could explode to dozens of times above that value. That's what so much of estate planning is. It's valuation, having a solid basis for valuation, but then sort of saying, well, this asset, though, it's worth X today. It may be worth 10X or 50X or 100X 5 or 7 years from now. Let me transfer that outside of the proverbial tax fence, beyond the proverbial tax fence, put it in an irrevocable trust, make sure that there's nothing that causes a boomerang or string provisions for estate tax inclusion, get it outside of my estate for tax purposes. Oh, by the way, keep it in a grantor trust, because if it's a grantor trust, this way you have the additional benefits that if you sell the interest to it, or you have loans going back and forth and promissory notes, it's a grantor trust, even though it's beyond the tax fence, it's still one and the same as me for income tax purposes during my lifetime, which means no tax friction whatsoever. It also means that to the extent there are gains there, I will pay the tax as a grantor, which actually is a very good thing for estate planning purposes. Why? Because I diminish my estate by paying the tax, but it's not a taxable gift because the IRS in Revenue Ruling 2004-64 said it isn't a taxable gift because I'm discharging my own personal tax liability. Wonderful, wonderful vehicle for planning. That's the name of the game here in planning with private investment fund interests. Transferring the carry, Now, as we'll talk about, there are lots of things to watch out for, potential tax traps associated with it. But that's what we're getting at here, trying to transfer the carry. Now, importantly, there's this notion of a distribution waterfall. And the key thing to illustrate here is that the interest in the carry, the pro rata distributions you see all the way at the bottom to the general partner and the limited partners, that's the last leg as far as this distribution waterfall. Waterfall being a sequence of distributions. You don't get to the distribution of residual investment gains akin to a common stock interest. I know it's a partnership structure, so you don't have common stock, but the same principle that applies. You have all these preferred interests. You have all these allocations that take precedence in accordance with the terms of the governing fund documents. Only after the distributions return to limited partners of invested capital, return to partners of management fees and expenses, the preferred return, basically the return that's called for the fund documents, general partner catch-up distribution, the part of the carried interest. And then you have this quite often a 20%, 80% allocation. It doesn't have to be. It could be more than that. It could be less than that. This is negotiated. But just in terms of what we see more often than not, 20% to general partner, 80% to limited partners. That 20% interest, the interest in the general partner that owns a 20% interest, and the interest in the fund manager in that general partner, that's that carried interest. That's what we're talking about here. Last in line in sequence, there are distributions above it, which for tax law purposes, we're going to consider preferred distributions, senior equity interest, whereas the carry is junior. Why is the carry junior? Because it's last in line for distributions, also last in line if there ever were a fund liquidation to receive amounts. Very, very significant. Let me just talk here. So why does it matter? Why does it matter? Well, there are rules that you have to be mindful of that may not apply necessarily. It may not apply, but you have to have your antenna up in case they do apply. And if you have any doubt, we have estate planners tend to be conservative creatures. We say, okay, let's plan in a way that takes into account that these rules potentially could apply and utilize the exceptions set forth in these rules in order to avoid a potential untoward tax result under quote unquote chapter 14 of the Internal Revenue Code, specifically section 2701 as its application. So what's the ordinary principle for valuing the interest, valuing the carried interest, all the other interests indicated in the waterfall as far as return of capital interest and like preferred interest? It's fair market value. That's a general rule. And fair market value is basically the price that property would change hands between a willing buyer and willing seller, neither being under any compulsion to buy or sell, and both having reasonable knowledge of relevant facts. Now, importantly, in the context of preferred interest, there is a revenue ruling, 83-120, 83-20 indicated towards the bottom of this page, that establishes guidelines where you have this preferred structure and how you value the preferred interest, which in turn informs how you value the common interest or the residual interest, something to bear in mind. That's the ordinary rule, okay? Now, against that background, we have special rules that were enacted in 1890 by Congress as part of sections 2701 and 2704 of the code. And they were not focused on private investment funds. Importantly, they were not focused on private investment funds. But I mention them because the way these funds are structured is they lend themselves potentially, depending on the circumstances, to these rules applying. Again, they may not, but your antenna must go up whenever you have a private investment fund because you have these different cash flows. The concern with these rules that were enacted by Congress in 1980, not thinking at all about private investment funds, is let's say you have a common interest and a preferred interest. You recapitalize an entity, a senior family member, let's call it dad, let's call that person dad, retains a preferred interest that's supposed to pay 8% a year. and transfers a common interest to kids or a trust for the benefit of kids and maybe grandkids too, thinking in terms of generous skipping transfer tax benefits as far as being able to allocate GST exemption to it. Well, there were, prior to 1990, when Chapter 14 of the Internal Revenue Code was enacted, there was a potentiality for abuse, and there were cases that involved such perceived abuses, because it would turn out that quite often that 8% or 7% or 9% interest, that preferred interest that was supposed to be paid to dad, maybe dad and mom and the like, wasn't paid. It wasn't paid. However, the valuation structure in determining what ultimately gets allocated for valuation purposes to the common interest, the residual interest, the growth interest, would take that into account. And there were perceived abuses. So what Congress did in 1990, it enacted Chapter 14 into the Revenue Code. There were prior attempts towards that, but ultimately we're focused on what was ultimately enacted in 1990, October 1990, and said in this structure we're going to have a whole bunch of sections that are going to be designed to prevent an artificial overvaluation of what's being retained by the senior family member. And why does it matter? It matters because if you ascribe more to what's being retained, then you're ascribing less to what's being given away, to what's being gifted or potentially sold or otherwise. And established a general rule here based upon the subtraction method, that unless you have a qualified interest, unless you have something that meets the letter of the Revenue Code, in the context of entities, that's under Section 2701, in the context of trust, involving grantor retained annuity trusts, a qualified personal residence trust, GRATs, keepers under Section 2702, also other various provisions concerning buy-sell agreements, 2703, and various liquidation rights, voting rights in Section 2704. But unless you meet the letter of the code, associated regulations, we're going to say this retained interest, this preferred interest, is going to be valued at a big whopping zero. Let's see, just to make sure. I think this looks like a zero, holding it up. What does that mean to be valued at zero? It means that there's a deemed gift of everything that's retained by the senior family members to the junior family members. A very bad gift tax surprise due to zero valuation. Now, importantly, Chapter 14 doesn't apply in every case, okay? Doesn't apply to publicly traded securities. It doesn't apply, and this is very, very important. This is where you got to dig in, roll up the sleeves. Transfers, interests, and corporations that are not controlled by the transferor's family. It's got to be controlled here, subject to an exception, unless it involves certain liquidation, put, call, or conversion rights. Those are referred to as extraordinary payment rights. This talk does not address SPACs, special purpose acquisition companies, but quite often there are warrants that are involved there, which basically are extraordinary payment rights, which is why anytime you're planning with SPACs, interest in special purpose acquisition companies, you have to be mindful of these rules as well, even though it's a completely different structure. But that's why there's a further exception here. So not just where you have a lack of control, unless you have those extraordinary payment rights, where you see it's in red, direct transfers of interest in corporations and partnerships, the transfer retains only stock or partnership interests of the same class as those transferred, which means that if you mirror the class of interest being transferred, what's being retained, and this is an oversimplification, but if you mirror it, quite often called a vertical slice, you give not just an interest, say 10% of the interest of the carry, but you also give 10% of the interest in the other cash flows, the so-called subscription interest, the preferred, the senior equity interest in this structure. In that case, that gives you an exception built into the tax code to this applying. That's why if you take one thing away from this talk, that is the phrase which is somewhat ubiquitous in planning, probably used more often than not, because again, you don't need it if you don't have a controlled entity under the tax code. But because we're conservative creatures, more than anything else in estate planning, we say with transfers, with interest in private investment funds, make sure you're doing a vertical slice. Because no matter what, if for some reason there are additional facts there that aren't brought to your attention as an estate planner, you know that you're going to be protected from this untoward, adverse, bad tax surprise for the client. Why? Because there's an exception to the zero valuation rule that applies here in the case of the same class exception, and you achieve the same class exception through the vertical slice. There are other rules that are indicated here. Now, very importantly, as I've mentioned, even if it's ultimately determined not to apply, as the slide indicated, you always got to worry about Section 2701 in the context of carried interest transfers. Because carried interest represent a quote unquote, as mentioned before, a junior class of equity. Why? Because it entitles a holder of it to a portion of the residual investment gains. Why do clients why do the investment fund managers want to transfer the carry? Because it's worth very little, quite often at the time of transfer, but can explode in value on the other side of the tax fence. Okay, so because it's considered a junior class, you always got to be mindful. Your antenna has to be up for these rules and think quite often in terms of vertical slices. Now, what's considered senior? Well, I'll list a few different examples. Fund managers interested in co-investment, subscription capital. Fund managers interested in partnership allocation in lieu of management fees. And also fund managers' interest attributable to the general partner's catch-up allocations and a hurdle before that carried interest becomes entitled to distributions. Usually there's a carve-out for tax distributions. So that's very important. Now, Section 2701, again, don't want to go too deep into the tax specifics except to alert to the rule, but basically there are applicable retained interest. That's the so-called bad retained interest that can be subject to a zero valuation rule potentially. And it's those are rights that are retained, interest that are retained, equity interest retained by the transfer or applicable family member. Applicable family member is someone who's considered senior to the recipient. So you're talking about retained by a spouse, ancestor of the transfer spouse, basically someone the same generation as or above the generation of the transferor. And if you have that, there are two trigger points as far as what could cause these bad tax results of having effectively phantom gifts of amounts that are retained because they're being given zero value. Number one is quite often you'll find, as mentioned before, in the SPAC, Special Purpose Acquisition Company type context with warrants, a so-called liquidation put call conversion right. The call is basically, the warrant is essentially equivalent to a call. The term of art under the tax rules is the extraordinary payment rights. And then the second, which we deal with in the private investment fund, private equity fund, hedge fund context, is a distribution right, but only, this is very important because quite often it's glossed over because of the zest, because of the safe harbor for the vertical slice. And I get it. You know, that's, everyone thinks vertical slice here. But technically, it's not just technically, it's under the statute. Talk about it in a second. This distribution rights for further interest, it only applies to the transfer and applicable family members. Applicable members of the transfer's family control the corporation or partnership. It's got to be called a controlled entity. And what is a controlled entity? Well, it depends if it's a tax rule statute actually says what it is. You have to consider attribution rules for it, but you look to see, is it a corporation or partnership? And it has to be something that's controlled immediately before the transfer by the transfer, applicable family members, and any lineal descendants of the parents of the transfer's family. If it's a corporation, again, not going to be the case quite often in private investment funds, but control means holding at least 50% of the total voting power or total fair market value, the equity interest of the corporation. If it's a partnership, including a limited partnership, control means a couple different things. It could mean holding at least 50% of either the capital interest in the profits or the profits interest in the partnership, or, and this is taken from the statute, in the case of a limited partnership, control also means holding any interest, quote unquote, as a general partner. Now you see, as a general partner, I emphasize the word as, because that's not the same as holding an interest in a general partner. There's some concern that having a 2%, a fund executor, private equity fund or hedge fund executor, having a 2% interest in carry is a triggering event. Again, we're conservative creatures. Quite often we'll counsel clients to have the vertical slice, and quite often it could make sense from a planning point of view to transfer this an equal percentage subscription interest in addition to the percentage of one's carry holdings that you have. But that's an interest in a general partner as opposed to an interest as a general partner. Always consider attribution rules. But there's a wonderful illustration via a private letter ruling that actually Jonathan Blockmacher obtained back in 1996. It's 96-39054, PLR 96-39054. And there, the IRS went through a lattice work. It went through facts and said, we don't have a controlled entity for Section 2701. Why? Because if you look at 2701 B2, the statute here, the interest in the general partner was only 37% controlled by family members. And you need 50% to have interest as a general partner, taking into account attribution rules. So that's something to consider. That being said, we tend to be, I don't want to say chicken, but maybe that's the appropriate word, conservative. And quite often we're concerned, what facts are we not told? Could there be an extraordinary payment right, a warrant involved? So quite often the nature of the planning is, let's just go ahead and do a vertical slice, which means not only do you give, say, the 10% of one owns in the carry, but also 10% of one owns in every other interest in the fund, such as interest in subscription capital, potentially also in management fees, in management fund structures, management company structures too. You always have to be concerned about attribution rules, especially when you're planning with grant or trust. Again, we love to plan with grant or trust. Why? It allows for multidimensional planning. You get the assets with the irrevocable grant or trustee outside the tax fed, so it can grow outside of one's taxable estate. But for income tax purposes during the grantor's lifetime, it's one and the same as the grantor, which is huge because it means that I can sell assets to the trustee of that trust. Is it a cap? Does it give rise to a gain if I sell it? No, because revenue ruling 85-13 says that I'm selling to myself, and therefore it's doesn't give rise to taxable income. What if I lend money to it and take back a promissory note or applicable purposes? Is that going to give rise to interest income to me as the lender, as the grantor, as a lender? No, because under revenue ruling 85-13, I'm deemed to be lending to myself, and therefore I cannot have interest income or interest expense in a transaction myself. So we love to plan with grant or trust. One thing to bear in mind, though, is that there are attribution rules that apply. And the way these attribution rules work, they also consider, among other things, not just a transferor, but other members of the transferor's family who are considered senior. So if, for example, transferor, fund manager has given an interest in a fund to another family member, such as a parent or a sibling, those interests count as well for purposes of determining whether it's a vertical slice. So you got to take that into account too. If you ignore it, you actually don't have a proper vertical slice. I also mentioned briefly, so it's not just distribution rights in a controlled entity. Controlled entity, again, interest as a general partner, taking into account attribution rules, as opposed to interest in a general partner. But there also could be, and this is something to consider, and quite often arises where you have special purpose acquisition companies, SPACs, because of warrants, extraordinary payment rights, which include warrants. And those too could be triggers for Section 2701, which is quite often why you want to see vertical slices there. Because even without a controlled entity, if you have warrants or extraordinary payment rights, quite often, if that happens, you need to make sure you have a vertical slice, because otherwise you could have the untoward give tax surprise of Section 2701. So there are different types of payments under the tax code are not considered extraordinary payment rights. If you have, for example, guaranteed payments because there's no perceived abuse there as far as valuation, because the payments are guaranteed and have to be paid each and every year, that's not going to be an interest that triggers the application of these rules. But quite often in the structure, that's not going to be problematic. So how do we plan in this area? Usually, benchmark for planning is what's highlighted here, the vertical slice exception. And again, quite often you have an interest in a fund that's being transferred where the transferor, the senior executive, has less than 50% taking into account attribution rules. But again, we quite often, what's the convention? The convention is, we don't know what we don't know necessarily. There could be other associated funds, and there could be warrants and the like. We tend to do a vertical slice, which means that we give a proportionate interest of everything that's owned by the fund manager, and also other senior family members. Bear in mind, again, if gift were made to mom or dad of an interest in the fund or to a sibling, that's got to be taken into account too. And if there's an interest in, say, a 10% interest that's given away from the carry, well, that means the other interests in the funds that are held, including management vehicles, to the extent it can be done, should also, a corresponding 10% interest should be given away too. Now, again, that could pose issues because quite often there are restrictions on who can be transferees, especially management vehicles. But that's just something to bear in mind. Technically, any associated related interest in the fund should be transferred on a vertical slice basis, 10%, 10%, 10%, 20%, 20%, 20%, if you want to fall within the exception. Just something to bear in mind, this is sometimes discussed, my friend Todd Agatovich. There are other ways to utilize safe harbors to avoid the application in 2701. You can set things up so that quite often there are quote unquote qualified payments that go back to senior family members. So you perhaps structure it so that there are preferred payments that go back that even without a vertical slice. So it's quite often discussed as non-vertical planning. If there is a payment made each and every year, and that must be paid each and every year, you can get the benefit of that. Even if you don't do that, you can make certain elections on the gift tax returns as per Section 2701 associated regulations to treat there as though there were payments, give it value. And as long as you actually make the payments within 4 years, I believe it is, get the benefit of those exceptions to the rules. So in other words, even if you fall outside Section 2701, or you're concerned that there wasn't a vertical slice done, there are various techniques that are allowed in the structure, including on gift tax return elections, to treat it as though it was done with qualified payments to get the benefit of various safe harbors. Okay, so that's the point of the first nugget on this slide. Even if you have a structure doesn't meet the definition of a qualified payment, an election can be made on the gift tax return to treat it as though it were a qualified payment. And again, you always have to say, well, what if there is a zero value? Again, if your early stages of the fund, maybe it's not worth a tremendous amount, and maybe it's not the end of the world. Especially with exemptions as high as already discussed, over $12 million, $12,060,000, which means for a married couple, you think in terms of doubling that to over $24 million. But again, you have to analyze this. You have to consider this. You always have to think in terms of strategies for safe harbors. Other issues to consider. Well, so we talked about interests that are held by the general partner, the carry, which then flows through on a partnership allocation basis to the executors in the general partner. But what about the fund manager's interest in the general partner? So basically, the fund manager is a partner, could be a limited partner in the general partner if it's structured as an LLC, a member. Non-managing member in the LLC. Quite often, you'll find that those interests are not fully vested from day one, that there is a vesting schedule. And again, part of the planning is to get assets to the other side of the tax fence. So a client might say, okay, my manager might say, all right, well, can I give that interest in the general partner too, even though it's not fully vested? Concern that arises there is the IRS could say, well, hold on a second, it's not fully vested. If you were to leave, go to another private equity shop or hedge fund across the street, be it in New York City or Greenwich or elsewhere, you will actually cause what you transferred to be worth zero, which means, and using an analogy to rules that apply to non-statutory stock options, there's a revenue ruling that addresses non-statutory stock options, 9821. 98-21, again, nothing to do with carried interest in private investment funds, but it's an analogy, and the concerns that the reasoning could be applied here, not aware of the reasoning ever being applied by the IRS, but that's a concern, and part of what we do in plan is we plan for potential concerns. That if you were to do that, if you were to move across the street, you could actually you could be affecting the value of what you've transferred. And because of that, at least in the non-statutory stock option scenario situation, revenue ruling 98-21, the IRS said in that ruling said, okay, we're not going to consider it to be a completed gift for gift tax purposes until later of the transfer or the time when the donee's right to exercise that non-statutory stock option is no longer conditioned on the performance of services by the transferor. Concern here is that reasoning, that analogy could be applied by the IRS at some point in time to a transfer of an unvested interest in the general partner and say, hey, you can go to the fund across the street, effectively cause what you transferred to your irrevocable grant or trust to be forfeited. You have strings as to what happens here. And therefore, until you're fully vested, you haven't made a completed gift, and you've tried to get it outside the transfer tax system, but you haven't. And at the time that it vests, presumably further down the road when the valuation is more, only then does your gift become complete, and becomes complete based upon the valuation that has grown at that time, which again could produce a very, very bad tax result because it could be a completed gift at a much, much higher value down the road. So that's something to be concerned about. How do we approach it? Well, generally counsel clients to say, transfer your vested interest first. Transfer your vested interest first, and also maybe have priority sequences if you prevail upon the general counsel of the fund manager to do that. To say, okay, you structure the assignment so you transfer in sequence that which is fully vested, and then transfer what is next in line to vest, so that this way, if this revenue ruling, the reasoning were ever to be applied, it would apply in as minimal way as possible because you transfer the vested interests and those that are next in line to vest, so that if the IRS were to say, not until there's vesting is there a completed interest, well, you minimize the potential harm there. So that's something to consider. One item that was a very big issue, income tax side, that we were very concerned about a year and a half ago, but now is no longer as much of an issue. So we'll address it just very, very quickly. Section 1061 deals with carried interest, profits interest in private investment funds. And it was enacted as part of also the Tax Cuts and Jobs Act of 2017. And there was concern that basically it says that to get long-term capital gain treatment, instead of short-term capital gain treatment, you have to have a 3-year hold. And that there was some uncertainty, especially under proposed regulations that came out, that if you were to transfer by gift interest in the private investment fund during that 3-year period, you may have an income tax triggering event at that point in time, and have an income tax triggering event not at long-term capital gains rates, but as short-term treated as short-term capital gain. And what's so bad about that? Short-term capital gain gets taxed just like ordinary income, which means no long-term capital gain preference, no 20% max rate. Plus we have 3.8% in net investment income tax, but rather taxes ordinary income 37% instead of 20%. It's like, ouch. There was a lot of concern there. American College Trust and Estates Council was involved in a comment letter project to U.S. Department of Treasury on that. Ultimately, in January of 2021, so less than 18 months ago, we had final regulations that were much, much more beneficial. I think much more in accordance with the statutory language and the proposed regulations were that says that this 3-year window that will cause a recharacterization of gain as short-term capital gain doesn't apply in the context of gifts. It already under the proposed regulations exempted transfers to grant or trust, but just in general, even if it's not a grant or trust, under the final regulations, you don't have to worry about it if it's an outright gift, even if it's not to a grant or trust. So just briefly on that, it's no longer nearly as much a concern as it used to be. I can tell you that there were proposals last year, September, October last year, that would have made these rules, that would have basically consider a transfer not just to be a recharacterization type rule under the 3-year short-term, long-term, short-term capital gain duality, but rather as an acceleration event. That has not been enacted. That basically was all left on the cutting room floor in the latest version of the bills that was presented in late October of 2021. And again, in the current environment of an election year, we're unlikely to see anything reappear on this until probably 2023 at the earliest. Something to watch for going forward, but as of right now, the structure into Section 1061 is favorable. You don't have deemed sales upon gift unless somehow there's some other triggering event like debt in excess of basis or something like that, and all safe there. Just a few more issues just to focus on. I see we have about 8 or 9 minutes left. So quite often for fund managers, there are arrangements worked out that says, well, you don't necessarily, that in exchange for not having to capital to make contributions, will reduce your 2% or 1.5% management fee. Concern there is that the IRS could say that that's really a disguised gift one way or another. The preferred approach to try to avoid that is to have any waiver or offset of the management fee in exchange for basically a reduced level of capital contributions to be hardwired in the structure from day one. Because if there's a waiver that occurs over the course of time, that there is a potential that the IRS could look at that as and view that dimly as a gift at that point in time. Why is it a gift? Because let's say you transfer the interest in the management company to a trust, irrevocable grant or trust outside of the tax fence for the benefit of one's children, grandchildren, can also include a spouse in there. At that point in time, if you say, okay, you're not going to have to make a capital contribution because I'm going to waive my fee on being paid for what I've retained, the IRS could say, well, why are you doing that? You're doing that to provide a benefit for family members in a trust outside of the tax fence. And the IRS could say that's a deemed gift. Again, so that's a concern there. Again, the best strategy to avoid that, if you can, is to actually hardwire the structure, quote unquote, hardwired at inception, so that any entitlement to notional capital can be transferred at the outset and valued as part of the appraisal, the carry, and the LP capital interest. Quite often, you'll see family limited partnerships and LLCs used as the vehicle to transfer interest in the private investment fund. What's the big advantage of doing that? Well, a couple of different things. Number one, if you have all the interest owned by a LLC or family limited partnership structure, and you just transfer the interest in the family limited partnership, you've got a built-in vertical slice, right? Because if done that way, if all the interests are owned by family limited partnerships or LLCs, and you just transfer a membership interest, percentage interest in that, you're transferring a little bit of everything on a complete vertical slice basis, built-in vertical slice. Don't have to worry about it. You can also potentially get, and there's case law that supports it in certain circumstances, an additional layer of discount, because not only are you transferring the interest in the fund, which itself is quite often structured, and just the economics of it is that it's non-controlling, non-marketable interest. But you have the second layer of the transfer of the interest in the family limited partnership at LLCs that itself is not readily marketable and is non-controlling. And a secondary level and would allow a second layer discount. That could reduce value even further. Although there, as mentioned, there is potential concern that if the only asset of that entity is that interest in the fund, the IRS could say, well, we're not going to allow it. That there could be pushback there, but it gives you additional argument. You got to watch out though when you do that, because anytime you transfer an interest in an entity and there is retained interest one way or another, including as a limited partner or a non-managing member of an LLC, there could be an application section 2036 string provision into the revenue code. And basically, the string provision says that, well, if you transfer an interest, but you either continue to retain beneficial enjoyment, or you have a situation where you can control how others enjoy. And you can control potentially how others enjoy if you have the ability to participate in distribution decisions, either alone or in conjunction with others, or have the ability pursuant to the LLC operating agreement to participate in a decision whether to liquidate the entity, either alone or in conjunction with others. That could be a trigger for estate tax inclusion. You have the PAL case, tax court case 2017, that held that. You had a limited partnership interest, not a managing member interest, not a general partner interest, but a limited partnership interest that was transferred shortly before death. And that was considered with a 3-year, with it to be a section 2036A2 taint, because you had a 2036 taint transfer within 3 years of death, and it wasn't done via a sale for full and adequate consideration, fair market value, and the like. You then had the 3-year look back rule, section 2035 applying, which means that everything that was transferred was brought back into the estate at fair market value without the benefit of any discount. So that's something to watch out for. Usually, especially in light of the Powell case, but even before it, but especially in light of the Powell case in 2017, you usually want to structure this so that therefore you maybe have two voting classes as far as distributions are concerned, as far as ability to participate in liquidation decisions are concerned, and completely wall off the senior family member who's made a transfer from being able to participate in any decisions on distributions and any decisions on liquidation. Again, you could have two different classes. You could potentially have built into the LLC operating agreement provision that says that such and such person cannot participate in any decision as to liquidation or distribution or any amendments of the LLC operating agreement that could somehow imbue such person at a later time in liquidation decisions or distribution decisions. That's something to watch out for in light of Powell. You can potentially get around this whole string issue if you have a bona fide sale for full and adequate consideration for money's worth under the so-called bona fide sale exception in section 2036. Problem with that is you don't find out that whether you've satisfied the test. Apologize for all the sun glare here. It's a beautiful day here in New York, in northern Westchester where I live, but lots of sun. You don't find out until when? Until death has occurred in the IRS audits, which means that there's a risk there. So the best way is actually to have no retained interest whatsoever, structured so that this way you wall off the grantor from having any interest in the LLC or family limited partnership to be able to participate in liquidation decisions, distribution decisions, or the ability to amend provisions of the governing instruments to somehow allow such person to at a later date participate in liquidation and distribution decisions. Various techniques. I only have about 3 minutes left. So just briefly, I've been touching on it. What can you do? Well, you can make gifts. We talked about gifts. You could also utilize grant to retainer annuity trusts, GRATs. They often don't work so well with private investment fund interest. Why? The way a GRAT is structured is I transfer an asset to this grant or retainer annuity trust. There's an IRS safe harbor, Internal Revenue Code safe harbor built in by Section 2702 of the Internal Revenue Code, enacted in 1990 as part of that bundle of provisions I talked about earlier, Chapter 14 in the code, that says, well, you got to take back an annuity amount, an annuity interest. And if you meet all the rules and you actually follow through on it, that gets value. That doesn't have a zero value as an interest in a trust, parallel to what we talked about for 2701 for an interest in entity. It doesn't have a zero value. We'll give you value. And usually it's structured so that I transferred $1 million, I get back about $1 million. There's a little bit of growth element. That growth element, July 2022, that's Section 7520 rate. It's now 3.6%. But if I transfer in, like, say, $1 million, get back $1 million, how much of a gift have I made? I've made a gift of zero. Usually it's de minimis amount, $100, $1,000. Just we feel more comfortable for gift tax reporting purposes to do that, and it's not a problem. Where this could be problematic for planning with fund interest is as follows. Well, you've got to pay back the annuity amount, which means what's going to be used to pay back that amount? Well, what's owned by the grant or retainer annuity trust? The interest in the fund. That means that you've got to transfer back an interest. It means, well, what if you get valuation wrong? That could be problematic. It also means, well, if we transfer back the fund interest, we lose all the leverage and upside that we're looking to obtain, especially the fund has it exploded in value. Keep putting aside the valuation issues. You might say, well, can I use a promissory note? The answer is absolutely not. The regulations under Section 2702 prohibit the use of financing arrangements, which would include a promissory note. There could be a loan from a third party, but make sure it's an unrelated third party. Think in terms of a bank or the like, but it cannot be self-financed, and I would not use related parties there either. So GRATs quite often don't work too well for those reasons in these private investment structures, unless perhaps it's a long-term GRAT. And problem with long-term GRAT is that you then have a mortality risk because the tax benefits can be unwound effectively for estate tax purposes if death occurs during the term of the grant or retainer annuity trust, say, be it 5 years, 10 years, whatever it may be. So quite often, instead, you'll have gifts that are used. You'd have sales that are used for carried interest planning. You fund a trust, this irrevocable grantor trust, and then you sell for a promissory note. You always want to have seed funding. I like to have seed funding, potentially 20% of the target amount, 15% I'm okay with. Probably get away with 10%, but I always like to be, what they say, outrunning the bear. You don't necessarily have to outrun the bear. You just have to outrun the low-hanging fruit to the bear. 10% would be the easier target, but if you can get to 15%, you're safer. Which means that if you have $1 million transfer, or you have $1 million in, 150,000 cash, 850,000 that's used as funded with a promissory note to purchase the interest in the carry, maybe do as a vertical slice, the capital interest as well. Promissory note at AFR, as mentioned before, those rates are going up. It's currently 2.99% here for July 2022. But that can work out extremely well. Why? Because as I mentioned, you get it to the other side of the tax fence for estate and gift tax purposes, but because it's an irrevocable grantor trust, sometimes referred to as intentionally defective grantor trust, IDIT, or IDIT, sometimes is used as the acronym for it. It gets it outside the tax fence for estate and gift tax purposes, but one and the same as the grantor for income tax purposes. What's the value with that? Again, twofold. Number one, it means my transactions, my sales, they're tax nothings during my lifetime. The fact that I get interest in a promissory note, disregard it. Revenue ruling 8513, disregard it. Right pocket, left pocket, the same person. And then when there's taxes to be paid by that trust, it's because it's as me being the grantor's obligation, don't have to worry about. I have to worry about it. I have to pay the taxes, but I'm discharging my own obligation. And again, Revenue Ruling 2004-64 says you discharge your own obligation. It's not a gift because that's your own obligation, even though it's through a grant or trust that's outside of your taxable state. It's also much more efficient for generous giving transfer tax purposes because you can allocate very clear. You can allocate generous giving transfer tax exemption to it. Really can't do it without significant risk if you're planning with a grad until after the grad term ends. Managing valuation risk, quite often we build in defined value formulas. I see I'm exceeding my time, so we'll conclude right here in 30 seconds, about 45 seconds. But quite often, the concern is, what if the IRS says you think what you transferred was worth $1 million? We think it's worth $10 million. You can have formulas basically built in that say that the overflow is finally determined for federal gift tax purposes, gets paid over to some sort of non-taxable recipient. It could be charity, donor advised fund. It could be a marital trust, a trust for the benefit with spouse, maybe a Q-tippable trust or a general power appointment marital trust. That could be helpful. You could also say, well, we're transferring such interest in the fund that's worth $1 million. That was in fact the situation in the famous Wandry case, tax court case from 2012. And in which case, instead of thinking that we transferred a 6% interest, maybe we only transferred a 2% interest in the carry and the capital and the like. But that's built in, all as filed in terms of federal gift tax purposes. The IRS is not acquiesced to Wandry, so there's a little bit more tax risk that depending on what circuit you're in, the IRS at some point in time might challenge that again. So that's something to consider. Or you can have a combination techniques and say that if at the end of the day, it ends up being more, the value is filed in terms of federal gift tax purposes more. In that case, you simply have more paid for it, the so-called King clause, named after the famous King case, 10th Circuit in 1876. The sale of interest is equal to its fair market value. It's filed in terms for federal gift tax purposes. If the IRS says it's worth more, then the trustee has got to pay more. And it could be by virtue of a promissory note, combination of cash and promissory note at the applicable federal rate at that time. So that is my discussion and highlights of estate planning and strategies for private investment fund managers. Some of the, the techniques, the rules, the concerns, the pitfalls, what to watch out for, what the current tax landscape is, how it potentially could change, and where we are today on June 28, 2022. Jonathan?
Thank you so much, Kevin, for that in-depth discussion. If anyone has any specific questions, new business opportunities, any of the issues they'd like to discuss, please feel free to reach out directly to Kevin or myself where appropriate. And I'll be sure to include his contact information in the follow-up email to this program. As I mentioned at the onset, the goal of all these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. 3 more quick items before I let you go. First, this was my final program for my summer webinar series. I'll send out invitations to my complete fall lineup in August. If you know anyone who would like to be on my webinar distribution list, please have them email me directly with the word webinar in the subject line. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. And I thank you in advance for that. Finally, if you'd like to be kept abreast of my latest articles, webinars, and all the other work I put out, you can feel free to sign up for my free monthly newsletter. Simply email the word newsletter to me in the subject line. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful summer, everybody.
Bye, everyone. Thank you, Jonathan.